you're in your mid-50s and you may be a Medtronic engineer or an executive, and you've been diligently participating in the company's stock purchase plan shares for 10 years or 15 years or even longer. Now you've been getting the sweet 15% discount on every purchase, and now your MDT stock is worth a lot of money. So it could be worth, say, $800,000, and you've only paid $400,000 of it to buy it and purchase it. And you're sitting on nearly $500,000 in gains. Now imagine your financial advisor telling you to sell it all and diversify, or just take the tax hit. It's time to reduce your risk. That advice just cost you a potentially $200,000 in unnecessary taxes. And sadly, I see this scenario playing out with a lot of Medtronic employees and executives, and ones from other companies as well. Now, you may be working there and have some significant stock holdings with your ESPP shares, and you could potentially save 6 figures or more in taxes. Now, that's why I want to share a story about how traditional financial advice has really devastatingly cost a lot of people a lot of money in tax, and that there's a smarter way for you. Now, let me tell you about 2 different Medtronic employees that we're going to call them Jill and Michael. Let's say both are in their early 60s. Both have been maxing out their ESPP contributions for years, and both ended up with identical positions. Again, all hypothetical here. They have about $750,000 worth of Medtronic stock with a cost base around $400,000. Now, that could definitely be doable. Jill went with the traditional financial advisor, and the advice was to sell everything, pay the capital gains tax, and let's get you diversified. I'm sure you've probably heard that before. And the tax bill would have been somewhere around $83,300 in just federal capital gains alone. And that's not even including state tax. So let's compare that to Michael. You see, he worked with something that we call NextPath, which is our custom indexing strategy, and it's specifically designed for highly appreciated company stock positions. Now, before I really tell you what happened to Michael, let me ask you something. If you could achieve the same diversification and risk reduction as Jill, but keep that extra $80,000 in your pocket, would you be interested? You see, here's what most people don't understand about their company stock. Whether you accumulate it through ESPP shares, like the Medtronic's 15% discount program, stock options, restricted stock units, or just buying it and holding on to it, the traditional sell everything and diversify approach is often the most expensive way to handle your concentrated position. And that is where NextPath comes in. It's a sophisticated custom indexing strategy that allows you to transition out of your Medtronic stock position that's pretty centralized, concentrated, while minimizing, in some cases, even eliminating the impact of tax. So what did Michael do differently? Instead of liquidating the entire Medtronic position at once, he implemented the strategy we have here with NextPath. And here's how it works. First, we transitioned Michael's $750,000 into another portfolio with other diversified stocks of really great companies that closely tracked the S&P 500. And here's the key. We did this without creating a taxable event. You see, his appreciated shares were contributed in kind into this account. Now, instead of owning just one stock, Michael is now owning a piece in 200 to 500 different companies, and it's reducing his overall risk. But we're not just done there. You see, through the year, the individual stocks in his portfolio experience normal market volatility, and that's where our system automatically harvests the losses. So when Apple went down by 5%, we captured that loss. When Tesla had a bad quarter, we harvested those losses as well. And here's the beautiful part, that we're capturing losses from these individual positions. Michael's overall portfolio was still closely tracking to the market because we're immediately reinvesting those proceeds into similar companies. And by the end of the first year, Michael had generated over $65,000 in tax losses through this harvesting process. And those losses then could be used to offset some of the Medtronic gains and gradually transition him out of that concentrated position. So compare that to Jill, who paid $83,300 in tax up front. Michael was already $148,000 ahead, and that isn't just in year one. Now, I know you've been asking yourself that this sounds like it's too good to be true. So let me share some information with you. There's been comprehensive studies that have been done on our custom indexing strategies, and we can generate what we call tax alpha, which is the additional after-tax returns of 1 to 2% annually, and it's purely through tax management. And in our modeling, this is based on a $1 million starting investment with an 8% annual return over 25 years. Now, there's the next path, which is our efficient custom indexing strategy, resulted in over $455,000 more in after-tax wealth compared to the traditional buy and hold approach. So that's where some of you now may be thinking, what about wash sale rules? Doesn't this create a lot of complexity? And here's the thing. These are all great questions and exactly what you need to be looking into and thinking about, and why we have these specialized strategies. You see, NextPath is a systematic approach that manages the complexities of the wash sale compliance rules. So it ensures that you're properly diversified. It handles all the complex tax reporting there, and you get the benefits without the headache. So yes, I've been working with a lot of corporate executives and business owners for well over 2 decades. I've seen many people like Jill pay massive taxes just because she didn't know. And whether you're sitting on appreciated stock from Medtronic or even other companies like 3M or Target, there's many tax efficient strategies and ways to diversify here that can help you as well. So here's what I want you to do. If you're watching this and you've had a concentrated stock position that's worth more than $250,000, and if you're approaching retirement with significant stock, I want to offer you a complimentary second opinion consultation. And during this meeting, we're going to analyze some specific situations and show you exactly how much you could potentially save using strategies like NextPath. And then we'll run the numbers on your actual positions, not hypothetical examples. And we're going to actually give you the elements with this strategy. But the longer you wait, the more you might end up paying unnecessary taxes. And Jill's mistake wasn't just choosing the wrong strategy, it was waiting too long to explore other options. You see, here's the thing. If you found this valuable, please hit the like button, subscribe to this channel, because I share a lot of this information and a lot of different advanced tax planning and wealth management strategies here every week. And you don't want to miss that. And then drop a comment. And if you have company stock and you're hesitant to sell because of the tax implication, I do read these comments and go through them. And if you're ready to explore whether NextPath, our custom indexing strategy, is right for you and all the advantages that this strategy has to offer makes sense for your situation, click the link in the description and schedule your complimentary second opinion consultation. You see, we'll spend some time analyzing your specific situation for no obligation. And remember, the difference between Jill and Michael wasn't luck. It was having the access to the right strategy and the right expertise. So don't let traditional financial advice cost you hundreds of thousands of dollars in unnecessary taxes. Now, you have a lot to do between now and the time we meet. I look forward to our meeting, And in the meantime, I have a lot of other videos right here just for you. Take care.